This feels like we've got one more long trading session ahead of us. Live from New York City this morning. Good morning, good morning. Equity futures down 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Wall Street banks throw First Republic a lifeline. Credit Suisse and UBS are said to be opposed to a tie-up as banks suck up billions from the Fed's liquidity backstop. We begin with the big issue, little fires everywhere.
We've had a series now of problems.
3 banks having been shut in the U.S.
What we've just seen in terms of banking system in the U.S.
And now, obviously, the stress we're seeing in Switzerland.
Good bank, bad bank, whatever you want to call it.
There's a long, long road ahead for Credit Suisse.
The bond market is the place where you see the volatility express itself.
What's happened is investors are sniffing out weakness everywhere they can.
The market is in the seek and destroy mode.
The fear psychosis about being blindsided on where the next risk is going to come from.
It will be seeking those weak links.
What's happened over the past week or so.
It is absolutely remarkable that Chair Powell teased that 50 basis point hike on Tuesday, and 24 hours later, the financial stress began.
It just makes you worry about a tip of the iceberg.
Next week's meeting is a tough call.
Let's bring in the Bloomberg team. Ollie Crook in Zurich at the Credit Suisse headquarters. Sonali Bassett, Michael McKee here in New York City. Sonali, first to you. First Republic right now in the pre-market, down 24%.
Call it the panic of 2023, John, because if you look at our bank rescue modeled after what was largely seen as what happened in the panic of 1907 or even long-term capital management in the late 1990s, you are seeing security last you less than a day. Again, as you said, the stock market moves are pretty drastic for First Republic. Even after market yesterday, remember, you have a lot of the market also betting on the bonds here. There's an ultimate end game question. Those are under the surface here because once you watch this deposit rescue float in just yesterday, you have questions about what happens next. What happens to depositor flight, not just at First Republic, but at other banks as well. The million-dollar question in the room is just that. The good news for First Republic here is you did see the banking industry step up to save First Republic, because if you see what happened over at Silicon Valley Bank quickly here, John, you have them 1 week after the FDIC rescue last week say now that the parent company is also filing for bankruptcy. Remember, this has been a very, very tricky sale process over the week. The question here for banks now is to make sure that other banks don't get to that point.
Mike McKee, big demands on the Federal Reserve. What else can they do?
That's a good question, because we're getting to sort of some of the limits of what they would be able to do and want to do, although our friend Gina Smiak has the book Unlimited, which suggests they can do anything. There's been a lot of questions about the balance sheet and whether they can continue to absorb things onto the balance sheet, because the $153 billion they lent out through the discount window reversed about half of what has been already taken out in QT. And the Fed at this point is having difficulty figuring out how far they can go. But it's temporary. That's the thing. It is not going to last. It's 90 days. And so it really isn't going to have a major impact on the overall cost of credit, even though we're seeing credit loosen up a little bit. It is going to go back the other way probably in a very short period of time. Then we look at what's going to happen next week, and there's a discrepancy here. Economists are pretty much convinced that the Fed is going to go 25 basis points, but you can see the market pricing there is no move. So markets at this point, or economists?
25 or 50. That used to be the conversation. Now it's 50 or nothing for the ECB, and now for the Federal Reserve, 25 or nothing. That conversation has changed really quickly. Mike McKee, Ollie Crook, Sonali Bassett, thank you. First Republic down 21% in the pre-market. Credit Suisse down almost 10% in early trading. Down 10% to about 182. I want to bring in Mohammed Al-Arian. He joins us from Queen's College, Cambridge. Mohammed, a wise man once said, beware of little fires everywhere. Mohammed, those little fires, your words, are they getting bigger?
They're getting bigger because people are questioning the fire department. They're questioning whether the crisis managers are up to the task. And the story today in the New York Times about the Fed pushing back on a negative reference to bank supervision hasn't done much to the confidence. So yeah, I mean, these little fires are getting to be messier, and the need for a circuit breaker is even stronger now.
Mohammed, what circuit breaker can they provide? You wrote earlier this week about the difference between what the UK did last weekend and what the United States did over the last week. This is what one senior Eurozone official described to the Financial Times. They said the following, and this is pretty brutal, Mohammed, it's scathing in fact. They're shocked at the, quote, total and utter incompetence of US authorities. Has it been that bad?
I mean, that's pretty, I think, exaggerated. But there's a reason why they're angry. They're angry because there is an international standard, an international understanding on how you respond. And that got thrown out the window last weekend by the US. And it may be that they didn't even consult with other regulators in doing this. But John, there's a bigger issue, and we've seen this with monetary policy. When you make mistakes early on in the process, your policy options become more and more restricted. You know, the market today, in the case of Credit Suisse, and to some extent in the case of First Republic, is asking about the viability of the business models. It's basically saying that these business models are under enormous pressure. Deposits are going to be shaky. Other banks, in the case of Credit Suisse, are going to step back from interacting, just look at where the credit default swap is. And therefore, the business model itself is under pressure. And what we've discovered is that it's not easy to sell a troubled bank to another institution. The Bank of England pulled it off wonderfully last Monday, but neither with Credit Suisse is proving very difficult to find another bank interested in taking it over.
Mohammed, they used the systemic risk exception for a bank that previously we wouldn't have considered systemically important. It feels like the game has changed, Mohammed. They're also saying things like, you heard this from Secretary Yellen yesterday, that all depositors in America can be confident their deposits will be there when they need them, but the FDIC still has a limit of 250,000. Are they trying to play some kind of Jedi mind trick just to encourage people to get their confidence back so they don't pull out their deposits, even though they're not going to change that insurance limit?
Look, I don't think deposits are at risk in the United States. I think the fact that you triggered that exception and you basically guaranteed deposits with no limit in First Republic's case means that you've de facto done it for other banks. And I think what you heard from Secretary Yellen is very important. Deposits are not at risk. It's the rest of the capital structure that is at risk. And that's why both the stocks and the bonds of Credit Suisse and certainly the stocks of First Republic are under so much pressure. It's the rest of the capital structure, but not the very top of the capital structure deposits.
Even the ultimate tail risk, even if that does not materialise, the takeaway at the moment, Mohammed, seems to be the following, and this came from Michael Hartnett of BofA, that bank emergency borrowing would lead to tighter financial conditions, tighter lending standards, small business credit crunch, and ultimately higher unemployment. We've heard it from BofA. I've heard it from Morgan Stanley, from Wells Fargo, from JP Morgan, from Goldman, take your pick, that they believe, base case now, that these issues in the past week will lead to tighter lending standards and softer growth. Is that your base case too?
Yes, they're right. There's going to be two reactions why that's going to happen. One is the banks themselves. They're going to put safety first, so they will tighten their standards. And second, there is a generalized expectation now that we will have tougher regulation, that you've had an accident on the freeway and the immediate reaction is going to be to lower the speed limit. So you will get it. The expectation is you better tighten your lending standards, both for your own reasons and then because there's going to be more regulations coming your way.
Isn't this going to take care of the Fed's job for them? Just this process, this sequence of events?
Yeah, John, I laugh when people say, oh, the Fed's policies are finally gaining traction. Is this the way we want the Fed policies to gain traction? By destabilizing the banking system, by creating a credit withdrawal, by having too much damage to the real economy and to jobs? You know, that's not how monetary policy is supposed to gain traction, not through financial instability. So yeah, to some extent, it does mean that the Fed will end up with lower inflation than would have been otherwise. But the journey there is terrible and it's unnecessary. I think the Fed has an immediate problem for next week, and that is that the ECB did a great job. I called it actually a masterclass on Twitter yesterday when I was listening to President Lagarde's press conference of separating price stability and financial stability and saying we have multiple tools for multiple objectives and we will not commingle them. And you saw the market's reaction to that. It was positive.
So let's talk about this then. What do you think the Fed will do based on the experience of the ECB?
I think this Fed, and now I'm going ahead of an FT column coming out on Monday. You always do this to me, John. I think this Fed will be very tempted to try and somehow be in the middle and say, we will not raise rates, but it's a pause. It's not an end to the cycle.
So you think a break? Would you call it a break? Take a break and wait?
I think that is what they will be tempted to do. I think that's the wrong thing to do. This is the wrong thing to do. You end up yet again in the muddle middle. You end up yet again flip-flopping. You end up yet again with inconsistent communication. But this Fed, I suspect, will be inclined to do this. I hope they don't, but it wouldn't surprise me if they're inclined to do this.
I wonder what you make of this psychology. Jana Randau, here at Bloomberg over in Frankfurt, she revealed, according to sources, Mohammed, that at the ECB, fears that anything but a half-point hike would trigger panic among investors. And they thought that if they didn't hike, it would send an even bigger signal. So ultimately, they settled on 50. What do you make of that?
No, it's very hard to comment on that because you don't know what the counter was going to be, right? You don't know what the counterfactual is. But I think, John, the reaction of markets says it all. When they announced 50 and when Christine Lagarde spoke at her press conference, the equity market rallied. And that says that they did the right thing. And it also suggests that had they not done that, it could have been the other way. But it's very hard to specify the counterfactual.
So let's wrap things up. In the last week, Bob Michael, JP Morgan, he said, these events, tip of the iceberg. Someone you know really well, we all really respect, Dan Iverson over at PIMCO. He said this could be a multi-month process. How would you describe this moment for markets now, Mohammed?
I think Dan Iverson is absolutely right. This is a multi-month episode, and it's not just multi-month on the financial side. It's multi-month, more importantly, on the economic side. Even if we are able to resolve these jitters in the next few days, and I really hope we can, we need a circuit breaker. Even if we're able to, the economic consequences, the political consequences, the social consequences are going to be with us for a few months. You know, John, when you started the show, you said this looks like it's going to be a long, and I thought you were going to say weekend. Think of Switzerland this weekend. They're going to have a long weekend in Switzerland.
Yeah, I said one more day of the trading week to go, and I think for a lot of people it feels like there's three, or maybe this week just never ends. Mohammed, wonderful to catch up with you. Thanks for carving out some time and teasing, the FT column on Monday. I did promise this a little bit earlier, Mohammed. I'd get your thoughts on Mr. Rogers going to the New York Jets. Is that happening?
Do I really have to comment?
You've got to comment. You've got to fit one in. Is that what you want to happen?
I have enormous respect for him. I think he's an amazing quarterback, but I'd rather we invest and be consistent with younger players than try. We've tried this before, and if it works for a year, maybe two, and then we're back to the same problem.
Is that like a Fed Band-Aid kind of thing, Mohammed? Is that what you'd suggest? Maybe.
You may very well say so. I couldn't possibly comment, John.
Mohammed, thank you. Always good to see you. Coming up on this programme, the ECB setting the stage for Chair Powell.
Let me reassure you, we are determined to fight inflation and return it to 2%. And we will take the measures that are necessary.
That conversation up next with Jack Manley and Brian Levitt from New York. This is Bloomberg.
We are not waning on our commitment to fight inflation, and we are determined to return inflation back to 2% target in the medium term. That should not be doubted. The determination is intact, and the path at which we will cover the ground, the pace that we will take, will be entirely data dependent.
The ECB staying the course and delivering that 50 basis point rate hike. Bloomberg's Gianna Randau reporting the following, that fears that anything but a half-point hike would trigger panic among investors, help settle the ECB's interest rate decision on Thursday. The concern of sending the wrong signal weighing on this ECB and setting the stage maybe for the Federal Reserve on Wednesday. Joining us now to discuss, JP Morgan's Jack Manley alongside Invesco's Brian Levitt. Brian, first to you. Can you take away something from what the ECB did to gauge what you think the Fed might do next week?
Well, the ECB has been behind the Fed with regards to tightening, so there is a little bit of catch-up that's going on there. And, you know, all this talk of that the market would have been disrupted had they not done it. I mean, again, perhaps Mohamed Al-Arian was saying you can't prove a counterfactual. But in the U.S., we have already seen the markets get ahead of this. The two-year rate has come down rapidly. The Fed funds implied rates have come down. So we've recalibrated, the markets have recalibrated for perhaps even a 50 basis point hike to maybe 25 next week. I personally would like, after all this tightening, and we know the lagged effects of this, for the Fed to take a step back and assess. But it seems like another 25 basis points is in the offing next week.
Jack, what about you?
I think, first of all, you have to draw a distinction between the environment in Europe and the environment in the United States. You know, to Brian's point, there is more room to run when it comes to the ECB hiking, but I think it's important to point out that there are very clear disinflationary signs here in the U.S. You can't really necessarily say the same thing over in Europe, at least not just yet. Which means that investors in the States, I think, are desperate to look for some sort of signal that the Fed is almost done. There is so much fatigue here. So while a 50 basis point hike might have been necessary over in Europe from the ECB, I can't really comment on that. I would say that if the Fed decided to not go to 50 basis points or not even go 25 basis points, that would be met with, I think, some sighs of relief.
They're trying to restore confidence in the banking system. We've got First Republic in the pre-market down at more than 20%. 11 banks in America coming together to deposit $30 billion US into this institution, and yet still we're lower. They've had to suspend their dividend. That's widely expected. Brian, all these things are going on. The authorities move on Sunday evening, and I'm sitting here wondering, what else can the authorities do at this point to restore confidence? And can this Federal Reserve really sit there around the table next week and draw a fine line, a hard line, a fat line even between the financial stability issues and the monetary policy objectives?
I don't think they can. I mean, the reality is, if you look at the history of policy tightening cycles in the United States, they almost all end in accident. Now, those accidents don't have to be 2008. I mean, 1984 with Continental Illinois or 1990 with the savings and loans crisis didn't become 2008. So I think investors could breathe a little bit of caution there. But it is disconcerting that, you know, with inflation at 6%, that, you know, the Fed's caught a little bit between a rock and a hard place here. But, you know, to my point on this is, you know, and I said it already, 12 months ago, the Fed funds rate was what, 25 basis points? By the end of next week, it's going to be what, 5%? I mean, that's an awful lot of tightening, leading to a deep inversion of the yield curve, which is creating some of these problems that exist on bank balance sheets. And I would view it as, look, if you don't want to go into an environment of banking challenges, which is at some point going to be inherently deflationary on the economy, I would recommend stepping back from the tightening cycle.
12 months and a couple of days ago, they were still at zero. They've done a ton, Jack, in 12 months. There are some people who believe this is just the beginning. I caught up with your colleague, Bob Michael, earlier in the week. He said, tip of the iceberg. Jack, how do you see this flowing through asset classes now from here?
I mean, when it comes down to the positioning in asset classes, I do think the story is still all about what Fed implications are. And at the end of the day, John, to me, financial stability is more important than inflation. And the Fed's going to have an awfully hard time transmitting monetary policy through a banking system that it's broken. And so I do think that we're probably going to see some sort of reprieve next week when it comes to that hiking cycle. I do think we're also going to get some signals that the end is pretty darn near if next week isn't in and of itself the end of this hiking cycle. net, I think that's pretty decent for longer-term, growthier risk assets that are going to be able to look through perhaps the next few months of volatility, perhaps even a recession, and see a terminal rate that is lower than expected and getting there a little bit faster than expected.
We're going to continue this conversation around the open and bow, but Brian, I just wanted to tee up what we'll talk about around the open, and it's this comment from Neil Dutta of Renaissance Macro yesterday when he said, look, the Atlanta Fed now GDP nowcast has basically got a 3 handle. Inflation's still 5-6%. We're looking at really high nominal GDP growth. There's a reason for the Fed to back away. Is that bullish? Now, Brian, is it?
It's bullish over the intermediate term period. I mean, we still need to see inflation follow through. So you're going to have some volatility until we start to see inflation get reasonably better. But the leading indicators of inflation suggest that we are going to see it come down. And far too often we're talking about being data dependent. Why not look ahead to what is most likely? The money supply growth has collapsed. Businesses have rebuilt inventory. Surveys in the apartment rental space suggest that market is loose as it's been since early days of COVID. So we're sitting here grappling with lagged data, GDP, last month's inflation, rather than looking ahead. And if we're right and inflation does continue to get better relative to expectations, that's when markets start looking ahead to recovery.
Let's keep building on this. Brian Levitt, Jack Manley sticking with us going into the open, 7 minutes away. Equity futures trying to stage a recovery, still lower by about 0.5%. Coming up on this programme, the morning calls and later, 2 banks, 2 lifelines and another day of double-digit declines. First Republic, Credit Suisse, feeling the heat. 5 minutes away from the opening bell. Equity futures trying to stage a recovery here. The Nasdaq positive again. It's been that way the whole of the week so far. Equity futures on the S&P down about 0.4%. That's the price action. Here's some morning calls for you. Wells Fargo upgrading Warner Brothers to overweight, highlighting undervalued streaming service relative to its peers. Cowen raising its price target for FedEx, $2.35, expecting 3Q results to keep it well positioned for a better second half. And finally, Wedbush downgrading First Republic to neutral, a $5 price target, citing valuation pressure in a takeout scenario. Coming up, turmoil in the banks, keeping Wall Street divided on the Fed's next move. That conversation continues with Brian Levitt and JP Morgan's Jack Manley. The Nasdaq every single day this week, Monday, Tuesday, Wednesday, Thursday, positive on the Nasdaq. 4-day winning streak, and on the week so far, the Nasdaq 100 up around about 6%. Can we add to those gains? On the S&P 500 futures, trying to stage a recovery here, going into the cash open, we're down about 1/3%. That's the opening bow. Switch on the board and get to the bond market. Yields look like this on a 10-year, down 10 basis points. Your yield right now, 347.34 at the front end of the curve. I've said it all week. The 2-year trading like a penny stock. The 2-year right now in America on the Treasury yield curve, we are down by about 9 basis points to 4.06%. Elsewhere in the FX market, Lagarde went 50. Powell will go who knows where. Euro dollar 106.29, we're positive 0.2%. And crude has had a really tough week this week. South to 70, 67.87 on WTI. We're down about 0.7%. We are about 30 seconds into the session. Your equity market looks a little something like this. We are negative 0.2% on the S&P and just about lower on the Nasdaq too. On the Nasdaq Composite, down about 0.1%. One stock to watch at the open, it's First Republic. A $30 billion deposit injection from the biggest banks on Wall Street failing to lift sentiment. Shares back down by 16 or 17%. Shonali Vasek, this has been a tough week for this bank.
It certainly has, and it regards the end game of this bank as well. On one good hand that you're seeing here, John, is the flight to deposits from the big banks over to First Republic helps shore up the confidence a little bit here. But there's still questions about whether this gets sold at the end and what that means for shareholders and bondholders. Remember, I think the bond action here is really interesting, falling below 60 cents on the dollar, back above, under pressure now as well as the equity. Remember, these bondholders are hoping for a sale at the end of the day. You also just have to watch how clients are moving also. I wanted to take a look at Schwab here as well. Sometimes it's a question about viability at the end of the day. Sometimes it's just a question about profitability. You have massive flows here from prime money market funds to government securities here. So that risk appetite of clients as well makes a big difference for a lot of these firms beyond that deposit flight.
Shanali, you've brought up a really, really good point. It's about the profit challenge now, not just for that bank, but perhaps the whole sector, and maybe the line between the regionals and the big ones here on Wall Street.
Yeah, I mean, I've never had more intensity, John, around an earnings season, because another big question here is where their deposits are going, how much they're fleeing the smaller ones, and what it means for the big ones. I think we won't get a full answer to that. I was in a bank this week, asked for a number on deposits. He said, I can't tell you because they're coming in so fast and hard. That means they've got to be taken out of somewhere else.
Shanali, I think we know a few of those names, don't we? Thank you. First Republic right now down about 16%. The broader banking sector following suit. A string of bank failures dragging the KBW bank index down 20% in 1 week, casting a shadow over the entire industry. The turmoil continuing to spread through lenders big and small. Abby has more. Hey, Abby.
Hey, John. Well, it really is incredible. And I would argue that it's exactly what you've been talking about this morning, a crisis in confidence. Yes, yesterday that backstop for First Republic tied it up a little bit with those stocks rallying yesterday. But the fact that you have these stocks down big time again today suggests that investors don't think that it's over, that some of these banks could, in fact, go the way of Silicon Valley Bank, or to Shanali's point that you were just talking about, the profit outlook. So you do have that KRE down once again. Big declines, down about 30% over the last 15 days, down 12 of those 15 days. And you can see that PacWest, Western Alliance, really doing the same thing. Now, we, of course, have the big banks backstopping the smaller banks, and those big banks such as JP Morgan, Citi, Bank of America last year forced to take these mark-to-market losses through regulatory capital. So they're down less. You can see the dramatic divergence over the last year. And it's not all bad, John. We do have the KRE, again, down sharply from its recent highs. That means some investors are trying to bottom fish. If we go into the Bloomberg terminal, we will see the inflows on the KRE. Well, I was looking all the way back to the banking crisis, or I should say the GFC, the financial crisis. These are record inflows right now, John, for the KRE.
Abby, thank you. What's a market check without Credit Suisse in the mix? That stock down by 8.6%, 185. Lower the session, 176, a break of 80. Again, a little bit earlier. A fresh dose of liquidity failing to put concerns over the bank's fate to bed. The stock heading for its worst weekly drop in 3 years. Ollie Crook has been staying close for us through the hour over in Zurich. Ollie, thanks for being with us, mate. Let's go through it. UBS does not want to dance, does it?
That's right, Jonathan. And really, the question is, it's the same question as yesterday, is how much runway does 50 billion francs buy you? And we turn to the market to try to answer that question. We see the shares down up to 11% today. You really don't want to see that if you're in the building behind me, 36 hours after that huge liquidity injection. And this invariably asks the question of what is the future of this bank? That invariably brings up this question of the tie-up with UBS and Credit Suisse. And invariably, it brings up all of the other issues that brings up, antitrust issues, the client base, and all these other reasons that, you know, that it may or may not make sense. And in many ways, it does not make sense. They do not want this. But here, the question is for me, John, after the 3 days that Credit Suisse has just had, how much of that business is UBS going to get for free?
That's a big question, and it's a similar question to what we've been asking here on Wall Street for some of the big players with deposit outflows migrating towards them. Ollie, thank you, mate, for that. Credit Suisse lower over in Swiss trading right now. Credit Suisse is down by 9%. First Republic is down by close to 21%. Jack, I want to come to you on this. Ollie, our colleague there, just went through everything that's happened this week with Credit Suisse. They've tapped the S&P for liquidity, 50 billion Swiss. We've seen 11 banks in America come together, deposit 30 billion at one institution here, and yet here we are staring at prices lower, aggressively so. Jack, what does it take right now to instill confidence?
John, I mean, that's a really hard question to answer because so much has already been done. You know, this feels like, to me, almost like a landslide here in terms of sentiment. People just not wanting to be the last ones out. You know, I do think it is important to draw a distinction here. Are you worried about the shareholders or are you worried about the depositors? And when you're looking at these institutions, whether they're here in the United States or overseas, the quality of these banks still seems to be reasonably high enough that depositors probably don't have a whole lot to worry about, especially when you you consider what the Swiss National Bank has done, what Lagarde said in her press conference yesterday, what the Federal Reserve did alongside the FDIC and Treasury over the weekend. But shareholders, I think, are in for a bumpy ride, at least for a little while longer, as the sentiment kind of gets sorted out around here and we find a bottom.
Brian, you say you are tactically defensive. What is that? And is defensive only in the NASDAQ at the moment?
Yeah, I mean, we started to see market sentiment deteriorate towards the end of February, and by that I mean you see credit spreads moving up a bit. The dollar got a bit stronger, so it was clear that the market was getting beyond its soft landing hopes and starting to think about below trend and weakening growth again. And so for us, that's a tactical shift to be more defensive. And when you're more defensive, certainly an increase of an exposure to fixed income away from credit towards higher quality bonds, but also moving up in size and shifting more away from value and cyclicals to growth and defensive. And so, it's been interesting what's been going on in the NASDAQ. Certainly the NASDAQ stocks, many of which were hated last year, are being viewed as more of a defensive position here. And they're getting the benefit of lower interest rates, which we've seen across the yield curve. And, this idea that prior to a few weeks ago, we were going to be persistently in a higher nominal growth environment, I think investors are coming around to the fact that we're going to return to a low growth environment. And in a low growth environment, investors tend to look for those businesses that can grow and sustain in that environment, and many of those are in the NASDAQ.
NASDAQ 100 up for a fifth straight session marginally this morning by 0.1%. Jack, is the NASDAQ defensive? It sounds absurd because a month ago it also sounded ridiculous and the NASDAQ was still outperforming. So is it defensive?
What a weird world that we live in, John, where bad news is good news for so many market indicators right now. I mean, I would say you could play this defensively because at the end of the day, the NASDAQ is growth and it's technology, and tech is ultra sensitive to interest rates. And if you want to have a silver lining approach to all the chaos, all the mess of the last 10 days or so, it's that the terminal Fed funds rate this year is likely going to be lower than we would have expected post Powell's commentary last week. That net is good news for technology. But, John, the caveat here is that it's not growth at any price, because I don't think rates are going back down to zero anytime soon. So I would agree with Brian's sentiment earlier that quality is key, not only in the bond market, but also in stocks.
Jack, do we have to pretend that inflation doesn't exist anymore for this trade to work?
I don't think so, John, because, if we're talking about lagging indicators, and I know that was sort of a theme of an earlier conversation, looking at that CPI basket, the shelter component, which is the biggest part of CPI, is a real lagging indicator. It just does not reflect reality right now. And if you look at what's going on with rental prices, they are starting to level off. We're seeing outright rental deflation in certain key markets like New York City. That's going to feed through very quickly into inflation. We already saw a 0.4 point drop from February relative to January. I think if we are patient just a little while longer, these numbers are going to get a lot better, a lot faster.
So, Brian, two issues. We talked about the NASDAQ and the outperformance in tech so far this week off the back of these monster moves in the bond market and the reduction of pricing out of Fed hikes, the pricing in of Fed cuts. Got all that. The other issue, Brian, that's come up repeatedly through this week are the guests that come on this program and talk about high-quality fixed income, investment-grade debt. And the question I keep asking, Brian, what is that? And can we get a little bit more specific? Because last week I can pick out some financial institutions that were also IG and now face existential risks.
Yeah, and you see it on the corporate side as well. I mean, when the banks are tightening lending standards, you're seeing corporate borrowing costs going up and spreads widening. So that's how these things typically play out. So you want to be a little cautious there. Obviously, you would favor investment-grade corporate bonds over higher yielding in this part of the cycle if you want to be more defensive. Now, with regards to treasuries and regards to mortgages, there's some banks that have been caught offside, didn't hedge their interest rate risk, or just did not believe that the Fed was going to be as tight as they ultimately were. But for investors in their portfolios, John, not that long ago, they were saying the 60-40 is dead. They were running out of the bond market, and what you find in periods of turmoil is that rates melt. And so investors looking at their statements at the end of this month are going to see that the bond component, the government bond, the high-quality bond component of their portfolio held in quite nicely, did perform very well during a period of volatility in the equity markets.
Brian, I just want to finish on this, looking at First Republic. It was halted after dropping pretty aggressively by 21%. It's resumed trading and it's down by more than that level now. Where are we? Down 22%. I've got the low of the week as 1750. We're at 2650 right now. Call it 2660. And as we've talked about already, Brian, this is developing even after 11 financial institutions in this country got together, banded together and put together 30 billion US to deposit in this institution. And yet still we face this as they suspend the dividend and face seemingly a real profit challenge as well. Brian, are we facing another one of those weekends where you're looking for a rabbit out of the hat before Asian trading starts, before we come back in Monday morning?
Well, it's possible. I mean, the one thing we see is that policymakers do stand ready to provide support if necessary, not necessarily to to save everyone, not necessarily to save the equity holders, not necessarily to prevent the bondholders from getting less on these things. But the reality is the policymakers stand ready to provide to maintain a functioning banking system. I think what investors have to realize is in a zero rate world, we had gotten very used to, all financial institutions being able to maintain it. It's not as if historically we don't get into these challenges. Tightening cycles tend to end with shocks and crises. Most importantly for investors, though, and Jack had mentioned this earlier, this is not, we're not sitting on with banks with piles of worthless assets and we're waiting over the weekend to see, how we're going to stem a contagion to the most globally integrated banks in the world. This is challenges that are very specific and nuanced to certain entities that were offsides for a much higher interest rate environment. So, yeah, we may continue to look to see for signs from policymakers that they're going to provide support, but I would caution investors about extrapolating that to mean that this is going to be the next global financial crisis.
Hey, Brian, thanks for that. Brian Levitt there, Jack Manley. More constructive view at the end. More constructive view of developments so far. 13 minutes in, equities down 0.4% on the S&P. Coming up, Treasury Secretary Janet Yellen in the hot seat.
What is your plan to keep large depositors from moving their funds out of community banks into the big banks?
That's certainly not something that we're encouraging.
That conversation up next with AMH down in DC and Allspring's Margie Patel.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Bob Diamond, CEO of Atlas Merchant Capital. That conversation at 4:30 p.m. Eastern, 8:30 p.m. in London. This is Bloomberg.
Every community bank, regardless of the size of the deposit, will they get the same treatment that SVB just got?
A bank only gets that treatment if the failure to protect uninsured depositors would create systemic risk.
Lawmakers grilling Secretary Janet Yellen over the government's response to SVB's collapse. Yellen defending the efforts, saying fears of contagion prompted federal regulators to act. For more, let's get to Anne-Marie down in D.C. AMH, what more can they do?
Well, that's a great question, Jonathan. And what a moment for the Treasury Secretary to be speaking to lawmakers under fire when you have this concerns in America about regional banks and, of course, the Atlantic issues with Credit Suisse. Her point yesterday was that for the regulators, number one priority right now is financial stability. But that moment there she had talking to lawmakers when she said that FDIC had to step in, concerns about contagion. That is the next question everyone has. Is this a precedent now that if there is contagion, the FDIC will be this backstop? That is a massive concern when it comes to these regional banks. And then, of course, today, if you look at what's happening with First Republic, questions is, was this enough? These big banks coming to the rescue of First Republic, of course, orchestrated by Janet Yellen and her colleagues herself.
First Republic right now down about 16 or 17%, trying to stage a recovery. AMH in Washington, Anne-Marie, great reporting, particularly on that meeting with Jamie Dimon and Janet Yellen just yesterday. That was from Anne-Marie here at Bloomberg. Margie Patel, of Allspring, looking for a silver lining if it's out there. Here's the quote. The potential good news for the economy is that the Fed may stop raising rates and even consider the possibility of cutting in the near future. Margie, I'm pleased to say, joins us right now. Margie, wonderful to wrap up the week with you on this program. Let's start with this question. Have they done enough?
Well, they've certainly done more than enough damage to the financial system. They raised rates more than they have in history of any cycle, 4.5 percentage points in a year. And after we had a period from 2008 really through the COVID crisis of 21, the 2-year short rates are below 1%. So what do they think would happen to the financial system with this huge adjustment in short rates? The rest of the economy looks pretty good. Consumers, business, leverage doesn't look good. There's no sector that's out of line, particularly compared to 2008, the financial crisis. So this is a crisis of the Fed's making. If they would admit their mistake, what I think they should do is cut rates by 50 basis points and say, we made a mistake. We need to unwind the liquidity crisis in the financial system.
Margie, as you know, there's probably a lot of daylight between what you think they should do and what they will do next week. We're still debating whether they'll hike. This market's been all over the place. I know your remit leans you towards the equity market a little bit more now, Margie, but the bond market, you've seen this bond market develop for decades. Have you ever seen it trade like this, the way it has done over the last week?
Well, no, and no one has, because we've never had a financial crisis when the economy is in pretty good shape, and we haven't had corporates be over-levered, consumers be over-levered. That's what's so remarkable. We've had a run on the financial sector. They should bring back the uptick rule, and perhaps that might control these huge outflows that we've seen of speculative activity in the banks.
How's your equity market call changed over the last week?
Well, I've always felt since the Fed began raising that the risk to the market was the Fed itself, what the Fed would do. And once again, they delivered on that. And they now have a situation that's pretty unsavory as far as financials are losing relative strength. People are panicked, taking money out of the bank, really making the crisis worse. But underlying that, other sectors of the economy look good. Technology, industrials, materials, healthcare, and consumers all look very healthy. So if the Fed would stop damaging the economy, I think the economy could begin to stabilize. And I think we're in for a period of modest growth. Inflation on its own was already rolling over. So we just need the Fed to stand back.
Margie, even if the Fed stands back, this is what people anticipate now, and I'll use the words of Michael Hartnett over at Bank of America. This is what people anticipate at the moment. Bank emergency borrowing will lead to tighter lending conditions, will lead to small businesses facing a credit crunch and higher unemployment. What's the argument, Margie, against that?
Well, the argument is if the Fed eased up, temporarily stepped back, lowered rates, you would see this financial indigestion in banks really, I think, subside. And you have to say to yourself, if you try to hurt the economy by raising unemployment, causing real damage to the financial system, what are you really accomplishing in this goal of trying to bring inflation to 2%, which clearly is out of their grasp to be able to do in the next year? The data have shown that.
Well, Margie, inflation's at 5 to 6. Again, it's not about what you think they should do, it's about what they will do. Given that we all expect they're going to hike maybe again next week by another 25, and people don't anticipate a big cutting cycle beginning anytime soon, why do I want to sit in places like industrials in the equity market? Why does that make sense to you?
Well, because if you can look past this temporary crisis, which is really not caused by fundamentals. It's caused by a dramatic rise in short-term rates and the Fed pulling liquidity away, now trying to pump some back into the banking system. The fundamentals of the U.S. economy really are too good to ignore. We've had big price corrections in loss of stocks, and so that says to me that if you can look over the next 6 months, the outlook for equities looks pretty good because the dividend yield is rising because of stock prices being lower. Price-earnings ratio is reasonable, and many of the sectors are in better shape than they've ever been, globally competitive. So it's a matter of being at the bus stop a little early before the bus comes. So I think it's better to stay in. And interest rates are really only providing a moderate alternative at this point.
Yeah. Got to avoid getting hit by that bus as well, Margie, just to extend the analogy just a little bit. Margie Patel there of Allspring, thank you. Equities doing okay, I guess. First Republic down about 16%. That is not great. Up next, your trading diary. It is going to be a long session for some of these banks. The Russell heavily weighted to the financials, struggling again, down a little more than 1%. The Nasdaq up for 5 straight sessions every single day this week, and the S&P down by 0.4%. As the price action, here's the trading diary. Coming up, the UMich Consumer Sentiment Survey, top of the hour. Looking to next week, US existing home sales out on Tuesday. ECB President Christine Lagarde delivers some remarks again too on Wednesday in the main event. Fed rate decision, Chairman Powell news conference, then the Bank of England follows on Thursday. From New York City, that does it for me. Good luck for the rest of the trading day, and if you can, enjoy the weekend. This was the Countdown to the Open. This is Bloomberg.